Good morning, and welcome to part 3 of the credit readiness. Okay, I can see the questions have started. We haven't even started the webinar, the questions have started. So welcome to the credit readiness workshop, part 3. My name is 𝑩𝒂𝒏𝒌𝒊𝒏𝒈 from the Sandbox, and I will be your host for this morning, for the next 1.5 hours. I'm very excited for you to thank you for taking your time, first of all, to just join us and participate. We really don't take it for granted for you giving us your 1 hour, 30 minutes, and we're very grateful. I hope you pick something interesting and amazing to take back to your business as we wrap up this session. I just want to speak a little bit into what Sandbox does, and what we do at the Sandbox is that we are an SME aggregator. So what that means is that we bring together different entrepreneurs who support other entrepreneurs. So think a marketing strategist, think a business strategist, think an auditor, think an accountant. All of them are based here at the Sandbox, and we currently house about 29 of them here at the Sandbox. And we pride ourselves in saying that we're the first of its kind. So there's nowhere you will go and you will find us. It is us. We are that unique and that special, and we pride ourselves in saying that we provide personalized solutions that are affordable for SMEs. So this is your home of SME solutions. It is the Sandbox. We are based at CMS Africa House on Chania Avenue in Kilimani, and you can always join us and visit us. I'll always walk in. Again, our doors are always open Monday to Friday from 8 to 5. So karibuni sana. And I just want to introduce some of the experts that we have on the call today, because we've been doing this in collaboration with a few experts, and some of them, I think you saw them on my screen earlier, and I'll just go back to that as well. So I want to start by introducing Michael, and Michael is a banking expert. So I didn't know there was someone called a banking expert until I met Michael. And I think I'd like Michael to tell us a little bit about what he does. Just say hi, Michael, and tell us what you do as we start the webinar today.
Thank you very much, Wendy, for that introduction. Well, I have experience in banking that has spanned over 17 years, both locally and international banks. So having been on the other side, one of the frustrations that I saw was that it seemed that the bank and SMEs were reading from two different scripts. There's what the bank expected SMEs to have, or to know, or to provide, but the SMEs seemed to be totally clueless, and it caused a lot of friction. So at 𝒂𝒏𝒈 Consulting, what we do is we bridge that gap between what the bank expects and what the SME is providing, so that when the discussion is being had about credit access, that discussion is much shorter, and of course, expectations are managed. And also we prepare SMEs for future funding. So in a nutshell, that's what I do. Thank you very much.
Thank you so much, Michael. I love that you're now in the general population or other SMEs now. You're not on the inside looking at us like you and your documents. So thank you so much, Michael. I want to call Thomas, and Thomas is the accounting expert. So when you think putting your books in order, the first thing that should come to your mind is Thomas or his business, which is Probity Consult, and he's the accounting expert at Sandbox. So over to you, Thomas.
Thank you, Wendy, for this opportunity. As you heard, my name is Thomas Warira. I lead an organization called Probity Consult at the Sandbox. And we work with organizations to help them put their accounting systems and processes in order, so that they are able to not only capture and record transactions, but they can generate information that they can use to make better informed decisions. So even within this webinar, we basically help support organizations in coming up with financial statements that then would be provided to these banks and metrics that the banks need and that. So thank you, Wendy, for that.
Thank you so much, Thomas. I want to call Doreen. So Doreen is the investor readiness expert, and Doreen has been with us for a while now. And when I think about her, I think about free money, because that's how I see technically investment is free money, but I have to work a little bit hard for it. So Doreen, over to you.
Hi, everyone. Wendy, can you confirm if you can hear me clearly?
Yes, we can.
Oh, fantastic. So as Wendy said, my name is Doreen Zaki, and I am the Investor Readiness Expert at Sandbox. So what I do is I work together with SMEs and businesses who are looking to raise capital from various funders. I know Michael had mentioned that he's the banking expert. So I now work on the other side of banks. So if you're looking to raise money from angel investors, private equity, venture capital funds, and etc., I help businesses put together the requisite material that is needed for investor engagement, which includes pitch decks, financial forecasts, as well as putting together data rooms so that it enhances the conversations you have with potential investors.
Okay, so Doreen, is it free money? Like, I know we said, is it free money?
There's free money, there's grant money.
Okay, and you'll talk to us about the free money on the webinar today.
Absolutely.
Okay. Lastly, I want to call on Duncan. Duncan, who is our audit expert, the person who does the ticking. Have you complied? This one. And I recently learned from Duncan there's something called an unqualified reports. Again, it's the most confusing term I have had in a while. So I want Duncan to introduce himself. Just to tell us what he does in audit and why it's essential for your business as well.
Thank you, Wendy, for the introduction. My name is Duncan Munyasi. I'm the audit expert at Sandbox. So as introduced, I help SMEs with audits and also with the what we call internal control strengthening within the organization. Thank you so much.
Thank you so much, Duncan. So I think we can continue. So what I want us to do is just to recap a bit of what we've covered the first two sessions. So in part one, we covered the rejection reality, and Michael shared that 75% of SMEs actually don't get loans when they go apply. They don't actually get access to that loan. And there could be a number of reasons as to why you don't get the loan. And you also give us a picture of what banks think like. So they look at even your credibility score, how you're spending your money, how you are recording your money. And there was also a small self-diagnosis of the business today. And one of the things that actually makes a bank not lend you money is something that they called commingling of funds. So it means that you took money from the business to let's see, to pay school fees, for example, or to go for a trip. It wasn't a business trip because you see, you didn't maybe put your KRA, all those things, but mixing your personal money and your business money and using your business money to do your personal things. So those are the things that banks look at you like, you lack financial discipline, or you're not responsible like that. We can't give you money. And what the lending gap is. So it was a really insightful session, and we were able to understand, okay, it means that these are the things that the bank is looking for, and I need to go back and work on my business. So part two, which was last week, covered financial foundation and governance. So we look at financial records, the ladder from receipts to audited accounts. So when we say the ladder from receipts to audited accounts, it means how you're keeping your books together. So is it an Excel sheet? Do you have a software that you use to put your documents together and your receipts together and your expenses together for your business, to actually working with an auditor to make sure you have audited accounts, and bank statement behavior, what actually flags you, cash flow, the language of credit, because again, I think they mentioned that you can't have, someone can't have paid you 100K today at 10:30, and by 11:30, your account is reading 110 shillings. You've already withdrawn everything because there's no steady cash flow within your business, and registration, carry, compliance, and governance signal. So as much as we're talking about money, there are things that actually affect your business when it comes to finances. And this is how you register your business, how carry looks at you, and what are things to look out for governance signals. So now you've done where you're being rejected, what you need to do to make sure that you have proper records and governance. And now today, Doreen and Michael will be taking us through your bankability score and alternative funding. And when we say alternative funding, I don't know what alternative funding is. I don't know if alternative funding is a loan from my mom when I want to start a business. I don't know what even a bankability score is. So Michael and Doreen will take us through a structured readiness index, how to score your business, a 90 credit readiness action plan, and beyond the bank. Because I know there are many places we can get money, but you just don't know how to do it. So Doreen will take us through that. So I'm hoping you have a pen and a paper, or you're writing all the notes. Please use the chat feature of the webinar to actually ask questions. Ask as many questions. We'll try and pick them up and answer them as we go. And I hope you really do enjoy the session. And I want to hand over to Michael just to, from the beginning. This is over to you, Michael and Doreen. Yes.
Thank you very much, Wendy. And before I start, I want to give a disclaimer. I have what is called a man flu. I didn't know its existence, but I've been told it afflicts those of my gender. And we tend to act like babies when we are afflicted by the man flu. But I am here to dispel all such rumors. The show must go on. So, karibuni sana to the final installment. If you missed the other two sessions, Wendy has done a recap. So today we are in the final installment where we talk about your bankability score. Those who were there before heard that the main thing that banks want to know is what you're telling us. Can we independently verify this through the documents that you provide? And each and every document that you provide tells a story. So we shall look at what we've developed called the SME Readiness Index, which is a structured way of ensuring that all these documents are packaged in a manner that is able to tell the story and to be able to give signals that the bank can assess the risk that they're about to take. Most of you believe that the bank is in the money business, but predominantly it's in the risk business. They are betting on past information as a predictor of future viability of your business, because that viability will determine whether or not that lending is risky. Excuse me. So very quickly, as we look at it, what we've developed, we look at 4 key pillars. There's the financing readiness. There is the governance and compliance, which Duncan, who is our auditor, spoke at length about. Then there's the process and systems, because this process and systems speak to the governance and also how viable or how structured your business is, and then market viability. So the first one is the financing readiness. And this is where a lot of you, when we did a poll, it said that 67% of you, of businesses, MSMEs, do not have records in place. So the first and foremost is financial records and financial forecasts. Because in as much as we are looking at the statements, we also want to project into the future. What has the trend been over the last 3 years? When we ask you for the for the management accounts, we are looking at past records. And what trends can you see from the ratios? And Thomas spoke at length last week about the ratios and what they speak to. And then we look at cash flow, because the cash flows are the ones which will determine where the payments or how the payments will be made. So if the cash flows are weak, we will be able, or rather, let me not say we, Wendy keeps reminding me, now I'm on the other side of the desk. The bank will be able to see your debt service coverage ratio. Do you have sufficient cash flows? And we looked at what ratios do banks generally look at. And we saw that if you look at the inflows, and then you divided it by the repayments, we needed a ratio of about 1.25 to 1.5 as a safety net, so that for every what am I saying? We needed about, it's okay, the show will go on, don't worry. So what I'm trying to say is there needs to be a sufficient buffer to not only repay the loan, but also to continue the day-to-day operations of the bank, of the SME. Sorry, I keep thinking switching back to the bank, but forgive me. And that's how we calculate the debt service coverage ratio. So what we've done is we've weighted it. how important is this in the overall determining of your financial readiness? So if you look at it, it has the biggest score. So it has a 30% score. And then the governance. Governance is in terms of business registration. How are you registered? Because it has legal implications. If you're a sole proprietorship, and this one we spoke to, if you're a business, limited liability company, if you're a partnership or a limited liability partnership, what implications does that have to the bank in terms of who signs and what security is required and who provides the security? So that is very critical. A lot of us have KRA is the boogeyman, the one who, when you switch off the lights, we want to check if they are under our bed. So you have to be compliant because it speaks to your character. So also that is very critical, that all your KRA compliant. And Simon, who's the tax expert, spoke to why and how that is done. Permits and licenses. Sometimes those are looked at as a measure of stability. Do you have an office? And if you have, are you paying your licenses? Sometimes some of us run the businesses from home, but it has inherent risks. And are you the only one running the business? Do you have the structures? CRB status. By now, most Kenyans are aware about CRB status. So if you are a company and you have 3 directors, the bank will want to know if all of you, what is the CRB status? Because it is critical to the lending relationship, because each and every one of you will have to give a personal guarantee. And if you have a default history, it speaks again to the character of the people running the business. And that is very critical to the business, because the bank has the view that if you defaulted in the past, and what were the circumstances of that default, is that a predictor that you may default in the future? True or not true, but the bank has to look at that and weigh the risk. Of course, we look at the structure, the senior team management. Who are you? Which people are in the business? How many employees are there? As a way of looking at the structure or the viability of the business. Then we look at the process and systems that you have in place. Do you have a financial management system? Do you have internal control or standard operating procedures? How are your stocks and assets recorded? Are they recorded? When do you do your inventory checks? How frequent? And then debtors and creditors management, because the bank can lend you, but does it know how the aging of the creditors? Do you give them 30, 60 or 90-day credit period? How does that impact the flow of the business? And then finally, and this is the one that is normally overlooked, or it's rarely highlighted, and this is where a lot of businesses, and I would say also it's a failure on the side of the banks. How viable is your business? So those of you who've approached a bank and you're told, give us a company profile, this is what the bank is looking at. What is the revenue stability and growth? Who are your main customers? So there's something called concentration risk. So if one of your customers provides more than 30% of your business, while it might be a good thing or it might be lucrative, there's a risk inherent in that kind of a relationship. There's something called key man risk. If you are the business, and this I speak to the consultants in the room, you are the business and the business is you. You're the one who knows the clients, you are the one who provides the service. If there is no continuity, if you cannot clearly articulate to the bank or the financial institution how that risk is mitigated, are there standard operating procedures in your absence, or if you're incapacitated, how will the business continue? Then that is a risk. So also your market position, you need to clearly articulate or define what is your position in your market. How have you distinguished or differentiated yourself from your competitors in the market? And then the sector risk. There are people in agriculture, there are people in construction, there are people, let's say, in the transport and logistics business. So like the disruptions that happen, what do you do? Or how does it impact your business when there are disruptions? Some could be internal, when a new competitor is happening, when a policy is done, how do you do that? So whenever you're asked to provide a profile of your business, these are the questions that the bank is looking at. And at the very first session, I said that you need to have a relationship with your relationship manager, if you have one, and clearly articulate this. And this is not a failure for SMEs. Even the bank relationship managers sometimes do not do a good job of clearly getting this information. And when they don't, what happens is when the file is taken to the credit committee, those are the questions which are asked. And sometimes if they're not answered correctly, that's when there's a back and forth. And that costs you time, and it costs you opportunities. Because we are all aware, and we are all Kenyans, that most of the time we approach the bank when it's almost last minute. We need to supply something. So if this is not clearly presented, then that presents a problem. Wendy?
Okay. Michael, we have a question, and I'm seeing that there's no one size fits all. That's number one. But number two, a big part of what constitutes to the bank looking at you, first of all, is actually the readiness in terms of what we talked about last week, the foundation, which is a big percent. 30% is a big percent. So is this the part where now you actually just do, even if it is, I think last week I was saying the bare minimum of I'm just recording my things on a spreadsheet, like even if it is just the littlest of the bare minimums, even as a consultant, because I know we've mentioned market positioning and sector risk. So even as a consultant, how I'm recording my cash flows, like I know I am paid on M-Pesa. Like let's say I have a till number, for example. I may not have bank statements and all those things where I have a till number, but I'm able to record this money came out, this money came in. So even the bare minimum of an Excel sheet is a good start.
Thomas alluded to this, and we spoke to this at length last time. The more detailed you are, the higher the access. So there are some which will give you access to, let's say, limits of maximum 500,000. Because if you only record them on an Excel sheet, of course, there is a story that you're not telling. So how verifiable is this? But someone else who has management accounts that have been audited, that have been prepared by an accountant and audited over the last 3 years, of course, the bank is willing to take a higher risk. So while it's true that you can do that, what it does, it limits the access to the amount that you can get. I don't know if that answers your question, Wendy.
It does. It does. It does. Thank you so much for that.
Yes.
I'm just imagine again. I think this session has really taught me that, yeah, I don't think I'm going to be an entrepreneur. Like, I think I still need to grow some skills that I'm able to actually do all these things. Because we talked about business registration, and I hope no one on KRA is on the call when they had us calling them the boogeyman, you know?
Yes.
I hope no one from KRA is on the call to hear us calling them the boogeyman. And I know even right now we have, I think there's something that is due to KRA. I don't know what it is. I had someone talk about it in passing, but I think VAT is due to KRA. And I know entrepreneurs are really feeling the stress of, hey, paying the boogeyman some more money. Damn it. But anyway, the show must go on. And I just want to, yes?
I'm saying it was due yesterday. Today is the 21st, so the 20th.
Oh my God. I can't imagine. To all the entrepreneurs on the call, you're brave. You're brave, and we really support you, and we're here to support you. So we've talked about now the Structure Readiness Index, but now there's the other thing that a lot of people don't have extensive knowledge about, and this is alternative funding, and where else to get money aside from a bank and aside from, for example, because I know there are circles that actually give you a loan to do your business and your things. So I just want to bring up a poll just now as we bring up Doreen, and the poll is just starting right now. So aside from banks and circles, have you tried getting loans from alternative financing? So if you can see the poll, please vote, because it also just guides us, how to get this conversation. And I can see We're at 50%, 62%, 37%. 62% have tried getting money from alternative financing. Most of you are voting yes. So I'm not sure what your alternative financing was. If you could tell us in the Q&A section, what was your alternative financing? Where did you try and get the loan from? So if you could tell us where you tried getting the loan from, would be really great. And did it actually work out? You know, because it also helps Doreen also figure out, hey, this is where you guys are getting money and I don't know. Yeah.
Yeah, so Wendy, as the poll
Yes.
is going on, I wanted to highlight at the bottom where once you consolidate those scores and the weightage that has been put across financing readiness, governance and compliance, process and systems, and market viability, what we've developed is we look at it and say, if you're between 0 and 39, you're not ready. It means there are gaps that you need to take care of, that once you close those gaps, then of course we can progress you. Then 40 to 59, it means you're developing. It means you have some semblance of viability or bankability, but still you're not as bad as someone who's not ready, but there's still some work. Then there's emerging. Emerging means that there are some banks who would consider you, but not all. If you get between 80 and 100, it means you have a fairly good chance of getting that loan. It means that the systems are in place, the governance is in order, and then the financing readiness and market viability. And also it's very key to mention that there's something called sector risk, and there's a credit policy. So in as much as you could be ready, each and every bank has a credit policy, and they determine which sectors are they leaning towards, or do they have a higher risk appetite. So you'll find that one bank is very big on construction. You'll find another bank is very big on agriculture. Another bank will not touch agriculture. But one thing I know is that trade is always, there's always money for trade. So if you're in trade, you buy, you sell, the risk appetite is higher for banks. So even if you do this, it also depends on which sector and which bank you approach. And like you said, Wendy, there's no one size fits all. So you might be denied by a bank, and it's because their risk appetite for that sector is very low, and another bank will accept you. So that's also a key consideration to make.
There's something you said that, 80 to 100, you might. It's the fact that I have done all the work and still at 80 to 100, I'm not getting I might not get the money after,
Yes.
80 to 100.
That's why I put the disclaimer and said, there's a credit policy. So there's a credit policy. So it also depends on the bank that you approach. It's also dependent. So you could be at 80, but you are in a sector that bank does not. So it would be remiss of me not to mention that what you do is you can prepare and approach 3 or 4 banks. I mean, as an entrepreneur, your biggest thing is to get a facility. And banks are out here competing because that's how they make money. So yes, you have a relationship with your bank, but it's good to shop around. It is, because once again, there's a credit policy. So if your bank does not have an appetite for your industry, then it doesn't matter whether you are at 100%. They will not lend you.
Thanks so much, Michael. And I can see the poll is still running. So I can see 64% have said yes, they've gotten alternative financing, and 35% saying no, they haven't gotten alternative financing. So I just want to bring up Doreen. So hi, Doreen. And now that we're discussing, the bank is not giving me money, the SACCO is not giving me money, what are my other options? I want you to take us through, what are the other options of money?
Sure, that's a very good question. And I think from the polls, we can see that 66% of people have managed to get their money from elsewhere, which is good. It showcases that indeed you can get money from elsewhere. So if we look at the world of money, and when I say the world, I mean Kenya, these are the various places where businesses can get money from. So let's just start from the top. MFI is a microfinance institution. I think we all know what SACCOs are and digital lenders. This is where a lot of businesses get their financing from. So you have like Kingdom Bank, which is an MFI. There are a few other, Credit Bank, a few other MFIs that are there in the market that you can get money from. So I've put there a number, and then each of these pockets of money, there's a number that I've put under. And this is the number that these industries, or rather these entities, have lent out to businesses. So if you look at MFIs, SACCOs and lenders and digital lenders, in total, they have lent 1 trillion worth of Kenya shillings to businesses. Well, at least according to ChatGPT. So there's another group of, let's just go down. So there's banks. Of course, there's been a lot of talks about banks, so I won't get into that. Banks have lent businesses in Kenya over 4.3 trillion shillings. Then there's another group called Development Finance Institutions. So, or they're also called DFIs. DFIs are sort of like banks, but they're regional banks. So for example, you'll have a DFI from Switzerland. So a DFI typically collects its money from the Swiss government and the Swiss pension funds and other Swiss institutional investors. So this development finance institution will sit on a large amount of money, and they will sit and they will say 5% of this money will be allocated towards Africa. And so they come and they look for specific African businesses that they can give this money to. A lot of development finance institutions come from the West. We have, as some of you might have heard of IFC or other DFIs. USAID was sort of a development finance institution. There's US money, there's European money, there's Scandinavian money. So that usually comes in as DFI money. And then we have NGOs, non-governmental organizations. These are other people that give out money to businesses. Then let's go to the top right. We have funds. So we have pension funds, investment funds. They also give out money to businesses. Then we have angel investors. Angel investors could be anyone. Some of us have also been angel investors ourselves, having lent money to our friends or family members who are looking for money for their businesses. The reason why I have a question mark, it's very hard to quantify how much money is being collected from angel investors, because that money is, that information isn't publicly collected. And then we also have private equity and venture capital funds, which is where I'd say my specialty mostly lies. So these are other types of funders that they can get money, that businesses can raise money from. I think we can move to the next slide. Okay, so let's look at the different fund categories. We have grant funders, we have debt funders, and we have equity funders. So grant funders, I want us to understand how each of these groups of funders think. So a grant funder is thinking, who are you helping? What is your impact? Yeah, that's what a grant funder is thinking about. What is a debt funder thinking about? And Michael has talked about this extensively with the rest of the Sandbox experts that have been on these calls in the last 2 webinars. Debt funders primarily care about, can you pay me back? Can you pay me back? And so how do equity funders think? So let me just maybe explain what they are. A grant funder is someone who gives money to your business but doesn't expect anything back. It is a grant, so it's for free. And I know Wendy was very excited about, can we get free money? So yes, there's free money. But the question is, what impact do you have that you're creating to get this free money? Debt funders, that's not free money. That's money that comes with an interest. Yeah, you have to pay back with a certain interest rate. And then there's the equity funder. What is equity money? Equity money, you don't pay it back. How it actually works is this person gives you, let's say they give you 1 million shillings. And in exchange of that, they want 20% of your business. So they actually give you money in exchange for shareholding into your business. The goal of a grant funder, a debt funder, and an equity funder are all different.
Doreen, I have a question. So
Sorry, go on, Wendy.
I have a question. There's something you mentioned about debt funders. And me, from my understanding as a debt funder, I was assuming that, they give me money to pay my debts. Like if I have debts, alafu like, is debt funding for operational, or is it to pay other, like, when you hear debt funding, it's like, oh, okay, someone is coming to fund my debts that I can be liquid kidogo, alafu I'll pay them as time goes by. Is that what it means?
That's a really good question, Wendy, and thanks for bringing that up. No, I'm talking about how can you receive money as a business? That's what I'm talking about. As a business, you can receive money as a grant, right? You can receive money in grant format. So if you receive money in grant format, it means you don't pay that money back. Yeah, what the grant funder wants is for you to showcase that you're able to create impact, and they want you to give, and I'll talk about this more in the next slide, they want you to give information and send them regular information on what impact you're creating. So if you're receiving money as debt, you're receiving money from a debt funder. So it's how you're receiving the money. Are you receiving it as a grant? Are you receiving the money as debt? If you receive the money as debt, it means that you need to pay that money back. If you receive the money as equity, it means that you don't pay back the money, but you give equity in return. You give a share of your business in return. So now to your question, debt funders. Do debt funders come in to pay off my debt? Yes, they actually do. Banks are notorious in doing this very badly, and Michael can correct me with that. Banks are not good with restructuring loans, but I'll talk about other groups of people that are open to looking at your debt, understanding what your debt is like in your company, helping you restructuring it, and coming up with a payment package that makes more sense. So what you're talking about, Wendy, is called debt restructure, and it does exist. It's not, but it does exist.
I did know there's something called debt restructuring. Again, I feel like every time I am learning something new about money and debt, and it is a lot. It is a lot. It is a lot. So now there's something at the bottom of the screen here, and I'm seeing concessional loans and mezzanine debt or quasi-equity. What is that? Because I feel like that is now Greek.
That's a good question. So before I even get to the bottom, let me talk about impact funders. So there's grant funders. I mean, they give you debt funders, equity funders, and then there's impact funders. Impact funders are asking, what impact are you creating in the city you're in or in the country that you're in? And the impact typically lies around the 17 United Nations Sustainable Development Goals, and I'll go into that later. So they're looking at what impact you're creating. So impact funders give things that are called concessional loans. So a concessional loan is, and I've put it in between a grant and a debt. So it is a loan where they give you $1 million, but the interest on that loan is so low. Sometimes it's 0%, sometimes it's 1% or 2%. It's very minimal because they're acting as a grant funder, but they do want their money back. So that's a concessional loan. It gives you concession. So it means you get the money, you have to pay it back, but you won't pay it back at the 16% loan rate that a bank would give you. You'd pay it back at 2%. I'll give you an example. There's an entity called the Kenya Development Corporation, KDC, and they're looking for specific SMEs that they can give money to. And one of the conditions that they have is that if you're a female-funded entity, and you're in manufacturing, or you're in the ASAL community, and I don't want to get into that, arid and semi-arid areas in Kenya, and you're doing business in those areas, they're willing to give you money at a rate of 8% per annum. Now, you can't get that in any bank. So that's just an example of a concessional loan. So let's move on to is that clear, Wendy? Are we?
Yeah, it is. So maybe just a quick question again. When it comes to a concessional loan, like now let's look at like the government as a business. Do governments get concessional loans? Is that what we're saying? Like, do they pay to the small interest, like a 2% interest?
So yes, the government does get concessional loans from other funders. You're asking, does the government of Kenya get cheap loans from abroad? Is that what you're asking? Right?
Yeah.
Yes, absolutely. Then there's so many programs that the government does get cheaper loans from, especially around health, around education, around sectors that are impact, like I mentioned. So if you're in an impact space, either as a government or as a business, it is possible for you to be able to get a concessional loan.
Okay, so what about mezzanine debt or quasi-equity?
So now, and I don't want to get into that because it's too complicated sometimes. So there's debt where you have to pay the money back, and then there's equity where you give shares of your business. But there's some people called mezzanine debt or quasi-equity funders where they will give you money, they will want their money paid back, but they'll also want a stake in your business. And so mezzanine funders typically work with high-risk businesses because if you're not able to have, like, for example, if you look at debt funders, typically they would want you to have security so that in the event that you are not able to pay back the loan, they will be able to sell your security and get their money back. Now, there are some businesses that don't have that level of security. Not all of us have titles of 100 million, or 50 million to get a bank from, an entity. So let's say you don't have a security worth 50 million. A mezzanine funder is able to give you additional funding. I mean, they're able to give you funding for your business, but they would want their money to be paid back, but they also want a stake in your business. So of all the sharks funders, I think mezzanine funders tend to rank at the top of shark funders. But if you're looking for money, there are many of them that you can reach out to if you're looking for funding.
I feel like that is, you can't, it's like having your cake and eating it. That is what it basically means. Like, it's like having your cake and eating it. Like I want to say it's like the greed that they talk about in the Bible, because you want me to pay you back and you still want to stake in my business. What's the highest stake that a mezzanine funder or quasi-equity could ask for in your business?
So it depends on the funder. So there are some funders who like to come in as minority funders. What that means is they want to own less than 50% of the business. Typically, they want to own between 15 to 30%. I mean, 15 to 30%. Yeah, they don't want to take over your business. They just want to have it's called a significant minority stake. I know it's minority. How can you put significant and minority in the same sentence? But it does exist. You're a minority shareholder, which means you own less than 50%. And so they can come in and say, look, we only want 25% of your business, but you run it. However, there are other players in the market who like to take a majority share of your business. So for the likes of those ones who've taken over, like the 𝑩𝒂𝒏𝒌𝒊𝒏𝒈s and the 𝑛aivases and the 𝑗avas, you can go Google them. They like to take majority shareholding in businesses. And so they would come in and they would say, look, I want to take shares in your business, but I want to be in control on how this business is run. And that's why, surprisingly, some of these businesses keep on growing. Like Java, you can say whatever it is that you want to say about Java, it has been consistently growing over the last 10 years because a large PE has taken over and said, this is how I want this business to be run. The same thing as QuickMatch. Remember what QuickMatch used to be like 10 years ago? The QuickMatch of 10 years ago and the QuickMatch of today is very different because the ownership is very different. How a private equity fund also runs a business is very different from how a business owner runs a business. And I don't want to get into that, Wendy, unless you want me to. But yeah, so there's some who can come in taking majority shareholding, and there's some who can come in and they're happy to just take minority shareholding.
I'm surprised that I'm still, and I think I'll come back to you later on that, maybe on the side. But now there are funding considerations that actually go into the types of funders, and we've mentioned grant, debt, and equity as the major ones. Just talk us through what are the funding considerations before, before all this thing, before the money comes in. What do you need to do?
Okay, so let's start with grant funding, and I know there was a question earlier about how do I put together a concept note for a grant funder. So I'll just give you an overview. What does a grant funder care about? They care about who or what are you impacting. Not only do they care about who or what it is that you're impacting, they care about what is the size or magnitude of your impact. Let's say, so I talked about United Nations Sustainable Development Goals. And for those who don't know, there's this worldwide agenda where they have 17 sustainable development goals, and this is how they're going to make, for lack of a better word, sentence, they want to make the world a better place. And so there's 17 things that the globe is focusing on to make the world a better place. And one of those things is reduce poverty, there's gender equity. So that's why you'll see a lot of money into female-owned businesses. It's because it's a worldwide agenda that's being pushed to give women more money, which is obviously good for us. And then there's, there are other things like climate action. So right now there's so much money in the market for climate action and various other things. So if your business is solving a problem, especially if you're, and I'd say go out and Google United Nations Sustainable Development Goals. There's 17 of them. If your business is aligned to any of these sustainable development goals, there's a good chance that you're able to get grant funding. And not only does your business need to align, it needs to showcase. So grant funders care about what is your impact. Don't say, oh, my business creates jobs and you're only creating 2 jobs a year. Yeah. If you're going to create impact, you need to create 2,000 jobs a year. So how does your business create 2,000 jobs a year? Especially right now, there's a crisis. There's high levels of youth unemployment between the ages of, okay, we all know what youth are, 18 to 35, the category that both Wendy and I are in. Yes. Of course, that sentence is not true. But in the youth category, there's a lot of unemployment. So if there's anyone, who has a business that is able to create additional employment, especially in the youth sector, there's money available for that. So that's grant funding. So let's move on to debt funding. And Michael, I think, has done a lot of justice in explaining debt funding and how they think. However, their bank, okay, so when I talk about debt, there's bank debt, and then there's other type of debt. So I'll talk about other type of debt that you don't get from a bank. But anyway, either way, whether you get the debt from a bank or from another entity, what they care about is, number 1, how much can you afford to pay back per month? Number 2, when can you afford to fully pay me back? And number 3, what can I sell if you can't pay me back? By and large, all debt funders think the same. Whether you're getting it from a bank or another place, all debt funders think about the same. Can I just get my money back? That's what a debt funder cares about. And so the third category that I mentioned was the equity funder. So the equity funder, you're not paying them their money back. How does an equity funder make their money? The equity funder makes their money if the shares of your business go up. I don't know how many of you here have actually invested in the stock market. Yeah. So when you invest in the stock market on the Nairobi Stock Exchange, I know there's this new app called ZD where you can now even buy stocks, online. I feel like someone who's advertising it. No, I'm not part of ZD Trader. But you can actually buy stocks you can go into your app, you can buy stocks online. What you're actually doing is you're taking shareholding in a company. So let's say you decide you want to buy equity stock. You've bought 1,000 shares. You are actually a shareholder of equity when you're buying that stock. So what do you care about? You care about, if I buy equity at, okay, I don't even know what price equity is at right now. If you buy equity at 30 bob, you're hoping that price is going to go up to 50 bob so that you're able to make a sale, and it's the same way. Anybody who's putting money in your business is looking for the share to go up. So now the most important question is, can your business, the only time shares make any sense? I know some people are very cautious about, I don't want to give shareholding into my business. Shares only matter if you're able to sell the business. If you can't sell your business to anyone else, your shares don't matter. It's a very painful, and maybe it may seem like an insulting statement, but it's the truth. If you can't sell your business to someone else, then your shares don't have that much value. If no one is willing to buy your business, then it doesn't matter. But if I look at your business and I think, this business is going to grow very fast, and I can sell my shares of this business to someone else in the future, yeah, then that's when I'll take equity in your business. So what does an equity funder think about? Number 1, an equity funder will think about, how big can your business get? Number 2, how fast can your business get to the place that you're saying it can get to? Number 3, what confidence can you give me that your business will go 3 to 5 times in 5 years? So there's this fancy thing that we like to say in this industry. Oh, my business is going to 10x in 5 years. When someone says their business is going to 10x in 5 years, it means that they're able to take their sales from 1 million shillings to 10 million shillings per year in 5 years. That's what 10xing means. So you can go flex some of these terms I'm showing you to people on the streets after this webinar. And then the other thing that is very important to an equity shareholder, who can I sell my shares to in 5 years' time? If your business is not one where that I can sell my shares to someone else, then that's not something that I'd be willing to put in shares. So now sorry, Wendy, do you have any questions before I go into the material?
I'm still stuck at the part where I feel like it was so harsh for your business needs to be sellable. What if I'm just in the business of just funtimesing it, and I have no interest in selling? Like, like I am just in the business of doing business. Like, I have no interest in selling the business. Is that a bad thing?
It's okay. If you're not interested in selling your business, some of us just want to start businesses to make money, to pay rent, to pay fees, and to have fun times, like you like to put it, Wendy. And that's okay. That's okay. And if, sorry, I see a poll is running.
No.
Oh, sorry. Anyway, so back to what I was saying is, if you just want to run your business for your own personal use, then technically you're not really running your business. You're a self-employed entity. That is not a business. You are self-employed, and that's okay. You are self-employed, and that's okay. A business is an entity that is able to run outside of you. And that is the goal. For you to have a business that is able to run outside of you, you're able to create systems and structures so that this business can run. Even if you decide to go to Hawaii for 3 years or 3 months or whatever it is, your business can still run. If your business cannot do that, it is unlikely that you're able to sell shares into that business, shares of that business. Or if your business is not on a trajectory where it can phase you out and still survive, then that is not a business. That is you are in a self-employment entity. And that's okay,
So
if that's what you want.
If the business cannot run without me, that's self-employment. But if the business, if I die today and the business continues, then that's an actual business. Is that what we're saying?
A business that you can sell, a business that can exist outside of you. It's a business that you can sell.
Okay, yeah. A business that exists outside of you is a business that you can sell. So I think for every founder, that should be the goal. A business that can exist outside that you can sell. Because as long as it exists next to you here and you're breathing the same air, then it is not sellable.
Absolutely. Absolutely.
Okay. Today's webinar is full of very harsh realities, like very harsh realities. And I think maybe just, Doreen, just talk us through about the grant funders, the examples, and what they think, like, and how they think before they put money into your business in whatever shape or form as well.
Okay, so just to answer the question that was posed, I think at the beginning, sorry, Wendy, if you can go back to the previous slide.
Here.
So what do you need to apply to a grant funder? So a grant funder is looking for a project proposal. In that project proposal, you need to be able to explain how you are creating impact in a quantifiable manner. Don't just say, I'm changing lives in Turkana. What does that mean? Changing what lives? I want to give people access to water in Laikipia. It is, I am able to build 5 boreholes. 5 boreholes is going to give an output of X amount of water, and this X amount of water is going to sustain 10,000 families in Turkana. It's important that you understand the language that you need to use when you're making an application, especially, and this is across the board, but especially for a charity, or if you're looking to get grant funding for your business, you need to be able to say, my business, by doing ABC, is able to create 3,000 jobs in youth, 3,000 jobs for the youth. And this is how we are going to do it. And you have a clear action plan on how you're going to create 3,000 jobs for the youth. And then you have a clear budget. You're able to say, and let's go back to my initial example, because there's a lot of money in water, by the way, and that's why I used boreholes. If you're looking for grant funding typically has preferences. The same way Michael has talked about how certain banks have certain preferences for certain sectors, grant funding has preference for certain sectors. Yeah, so there's a big issue of water availability in ASAL regions, ASAL, arid and semi-arid land across Kenya. And so if you're able to create a solution where you're able to bring water to these regions, you're able to get grant funding. So in your proposal, you talk about the budget, how much is a borehole, and your budget needs to make sense. A lot of people think that grant funders just have a lot of money. They're not your rich uncle where you need 5,000 shillings and then you ask for 25,000 shillings. No, that's not how it works. So what they do is, yes, they do have a lot of money, but they hire brilliant analysts who understand what prices are. So if you go there giving false estimates or numbers that don't make sense, these analysts are very good at what they do. They're able to look at your numbers and say, okay, this person is not even serious with this application. They just throw that application out. So you need to know your numbers. You need to know your costing, right? Unless this is one of those fraudulent grant government things that you're doing. You know, you need to have your numbers right for here. So for grant funding. So you need to be clear on your budget, and you need to also showcase what have you done previously. I have never worked in water. I have never done boreholes in Laikipia. I can't wake up. I can write a good proposal because of my training and my skill set. I can write a good proposal, but I still won't get money. It doesn't matter how great I am at writing a proposal. I have absolutely no experience in boreholes or providing water to people in Turkana. So they will not give me money, as excellent as my proposal would be. So you need to also showcase that you have done something similar, or you have a pilot that you have showcased where you're able to say, look, I may not have been able to reach 10,000 people in Turkana, but I've impacted 100 people or 50 people, and this is how I've done it. So you need to have previous achievements. So for debt, I won't get into that. Michael has already talked about that a lot. You need to have, but I know he's talked about mostly for banks. So there are other people who give debt. So for them, they look at your business proposal, they look at your management accounts, your bank statements, you know, they look at your cash flow analysis. So banks typically look at your historical information, but there are other debt providers, and I'll talk about them in the next slide, that look at, fine, banks care about how have you done in the last 6 months that can show me you can pay back this money. There are other debt funders who might not care so much about what you've done in the last 6 months. They care about, sorry, Wendy, just stick to that slide. Stick to that slide. We are coming to this one. So they don't care so much about, you know, what have you done? We're at the bottom half of this slide, yeah? So they don't care about what you've done in the last 6 months. They care, what do the cash flows of your business look like in the next 6 months to show that I can give you money? That's what they care about. What does the cash flows of your business look like for the next 6 months? So you need to be able to have a financial forecast. And this is what we do as investor readiness experts. We help you come with financial forecasts to show how your business is going to grow. And then they look at, you know, the risks of your business. What is it? What are your client acquisition risks? Like, for example, if you're a business and you have one client who's giving you a $10 million contract, that's great. But what happens if that person doesn't pay you? That's a huge risk. So they look at things like client concentration risk, etc. And so let me finish with the equity funder. Equity funder cares about the future of your business. So you need to have a vision. Where is your business going? What is it that you want to achieve? How fast are you going to grow? What is the opportunity in the market? What is the target addressable market size? You know, so they want to have a pitch deck with your growth story. They want to have a financial model showing this is how I think my business is going to grow. This is how much cash my business is going to generate. And then on top of that, they will still need your management accounts, financial, audited financials to be able to see how fast your business has been growing so far. You can't just wake up one day and say, look, I'm going to make $20 million in the next 3 years, and you've only been doing $5,000 for the last 10 years, you know. So it needs to make sense with what you have previously done. And then also an equity funder and also a debt funder who's looking at the future will do a lot of due diligence. So whatever a bank will ask you for, these guys, let's say you don't have security, right? But you have a growth story and you're selling a future growth story. They will do a lot of due diligence in your business, 10 times more than a bank. So if you think a bank is asking for too much information, then you won't be happy with these other groups of people who are willing to lend you money. And Wendy, now we can move on to the next slide. I know you're very excited to know who are these people who can give money.
Yeah, like I'm so curious, but I think we mentioned this maybe a few sessions back or even when we were prepping for the webinar, and you were telling us that you think getting money from a bank is hard. Let me show you. And I'm listening to all these things you're saying, and I'm just like, hey, this one, I'm not giving my kidney anymore. It is my kidney, part of my liver, some blood, some stem cells. Like, you know, I'm giving you a lot just for you to actually just fund my business. It's no longer walk in the park.
Yeah, but it depends, Wendy. It depends. If you want your business to just grow at a nice organic pace, you're growing at 5, 10, 10% per year, and you just want to grow at a sustainable rate over the next few years, that's okay. But Wendy, there's some people who are like, my business is doing $1 million this year. I want my business to do $10 million this next year. So there's some, and I don't know if they're here, there's some people who are very aggressive with their growth forecasts, and it's very difficult for you to grow organically 10 times in like a year or 2 times. The only way you can scale your growth from here to here in a very fast rate is if someone else gives you money, and that's just the reality. That is just the reality. If you want to grow fast, then you need capital if you want to scale that business very, very fast.
So I think we've mentioned, just before you get into who these people are, we've really talked about founder dependency and the fact that your business needs to be able to survive without you, for you to actually grow, be able to sell the said business and sell its shares. And there's a poll running, just can your business actually survive without you? So as we keep the poll running, maybe Doreen just carry on now to who these people are, who give grants, who give debts, and who wants a stake in my business.
Okay. So let's talk about grant funders. I know I talked about DFIs earlier. DFIs are development finance institutions. And Wendy, you asked a really good question. Can government get concessional loans, or can government get grants? Governments get grants all the time. So for example, some of the medication that you have in these clinics, in county clinics, those are usually given by grants, by the World Bank, and other entities like DFIs. So DFIs tend to give out large grants. So they give out $20 million, just to put that into context, that's like 2.5 billion shillings. So they give out billions of shillings in terms of grants, in terms of loans. So for you to get money from a DFI, technically you need to be a very large entity. Or a DFI can even give out concessional loans. We talked about concessional loans earlier on, where it says, look, here is money, but only pay me back at 2%. I'll give you an example. So you can have, and I said a lot of DFIs care about impact. And impact, we talked about the United Nations Sustainable Development Goals. So I'll give you an example. One global goal is to push gender equity, right? And so a way that they push gender equity is through giving female-owned business access to more money. So they'll go to Equity Bank and they'll say, look, here is $100 million. We want you to use $100 million to loan female-owned entities in your bank. So they'll give Equity Bank. Equity Bank will pay that money back at 2% per annum. And then they'll give it to us females at 25%. But I don't want to cause a ruckus in this group. But that's just an example of like money that can come from a DFI too. So they usually give to large entities. And so there are other people called angel investors. So for example, angel investors could be even church groups or groups of other people who just come together and they have a particular cause. They have a certain cause they want to help. Like I talked about people in water. There's some people who want to help people who are alleviating poverty or giving children access to education. So if you have a business that's giving young children access to education, especially children who can't afford it, you have angel investors. These are individuals who are just willing to give you money for that. And then you also have non-government organizations like USAID. USAID was very big on giving grants. And then Trump did his thing, and now there's less money available for grants, but there's still money available so now we're seeing money coming in from Europe, now that USA is behaving the way it is, which is fine. There's money coming in from Europe, and there's money coming from Scandinavian countries, and money coming in from UK, but not so much. And actually money coming in from, we're getting a lot of Japanese money for grants. So it's very, very important for the businesses here to do research on who's giving money for what. Japan is very big on health. They're coming to Africa and they're like, look, we want to, help anyone who is in health. Scandinavian countries are very big on climate. So if there's any one of you who's helping the climate, and then you have other entities, the Americans are big on, no poverty or female agenda. So it's very good to understand, and maybe we can have other sessions around that. Who's giving who, what money. That's an important conversation to have. Debt funders, they can be banks, they can be MFI circles, digital lenders, development finance institutions, like I mentioned earlier, also give debt funding. So PEs and VCs are private equity and venture capital funds. So our private, I know it has the name equity in it, so you think they give equity. Our private equity funds can give you debt. Look, even if you do, private equity funds are not big on security. Okay, let me rephrase that. The banks are very big on security. It is very difficult to get a large loan that is unsecured. But a private equity fund can give you a large loan that is not secured, as long as you're able to showcase what the future growth of your business looks like, and you're able to showcase. Sometimes, if it's an impact fund, sometimes they care about what impact what do you have in your business. And then you have some private equity and venture capital funds that are able to give you debt with great moratorium. We recently raised money for a company that I won't mention, but this private equity, actually they're an impact fund. They came in and they gave them $9 million, and they said, you don't have to pay us back in 3 years. So there's very nice money. Not everybody's a shark, Wendy. There's some nice people out there who are willing to give you large amounts of money with very patient terms. A bank is very unlikely you're going to get those terms from a bank, especially if you're not profit making, which this company was. They were not profit making, and yet they were still able to get debt. That's a story for another day. Other people that can give you debt, you can get funds. Angel investors can give you debt. Then we have equity funders. Equity funders, they can be the same. A development finance institution can give you money in exchange for equity in your business. A private equity venture capital fund can give you money in exchange for a stake in your business. Funds can give you money for a stake in your business. So when I talk about funds, what are funds? I mean like investment funds. Like I'm sure some of you have heard of ICEA, these money market funds. So, and I'm not talking about money market funds, I'm just talking about the institutional investor is called ICEA. So I believe most of us know what ICEA is, or Gen Africa Asset Managers, or CIC Asset Managers, or Jubilee Asset Managers. So what happens is these people, they take money from pension funds. They collect money from pension funds, they collect money from insurance companies, and they collect money from you and me. And what do they do with this money? They invest that money in government bonds, they invest that money in equities, and sometimes they invest that money in businesses, right? And so, however, majority of the way they invest it in businesses is businesses on the stock exchange. So you have to be on the stock exchange for you to get it. It's easier for you to be on the stock exchange to get this money. Now, all businesses think, I need to be this huge company to be on the stock exchange. They have changed the rules so many times to accept even small businesses in the stock exchange, but people have refused to go on the stock exchange. And I don't want to market on their behalf. They need to pay me. But Nairobi Securities Exchange has done a lot of work to try and get small businesses to list. And if you want to get fund money, list on the stock exchange. You don't have to be that big. You don't have to be that big, but I let them market their own platform. The other people that you can get equity fund from are angel investors.
Okay. Hey, me, first of all, thank you for restoring my hope that not everyone is a shark. Like, there are some nice people out there, willing to give me money, 9 million, and then say, you can start paying me in 3 years' time. Like, so for the first 3 years.
And even then, Wendy, sorry to interject, I've recently looked at the numbers. This business is not even able to pay them back in 3 years, right? So 3 years is ending next year. So they've come back to me saying, hey, Doreen, we can't afford to pay this money back. So now we've had to do another cash flow analysis to show, look, this business isn't able to pay you back in year 3 as you had hoped. Give them another 2-year extension. And the impact person will be like, okay, because they're creating impact, it's okay. I'll extend it for another 2 years. So that's, I spent the whole of last week doing that. So it's very possible for even them to extend it. So Wendy, when you talk about sharks, there's different types of funders. And I think I should have mentioned this at the beginning. So there are funders who want a return on their money. If I give you 100 shillings, I want 500 shillings in return. That's a shark. But there are other types of funders where their goal is not a return on their money. They're impact funders. Their return is on impact. So they get money they go speak to rich Dutch people in fancy hotels in Netherlands, in Amsterdam, and they convince these rich old people to give them 5 million euros. They can then come to Africa because they want to go back to these rich Dutch people to tell them, we have been able to give 20,000 African kids access to education. So they don't care about so much a return on their money. They care about a return on their money would be great, but then also you go back to these rich old Dutch people and you tell them, and this is a true story I'm telling you, by the way, you go and tell them we've helped 20,000 African kids get access to education. So not all money is shark money. So Wendy, if you can just go learn Dutch or and then go look for rich old Dutch
money out there. So we are 15 minutes out. We're 15 minutes to the close of the webinar. And Doreen, I just want to jump to something. So now we've talked about where to get this money. We've talked about what kind of kidney or lungs or what I need to part with so I can get this money. So I want to actually you to jump to the actual pathway to capital. So like now, the actual pathway. So like you've told me that this is all the money available to me, but what does the road look like to go there? So the actual pathway to capital. And I want to just make it as brief as possible because time is also not on our side as well. But we've talked about this is what I need to do as alternative financing. This is what is available for me. I know Michael and everyone else has mentioned that structures, governance, carry, the boogeyman, and all these things. So what is the actual pathway to the said capital?
Okay, that's a really good question, Wendy. And just to, I really had wanted to go through the case studies, but we can have another session to discuss that. So I'll end with 5 things. Number 1, the business needs to be very clear on the value proposition. And when I say value proposition is what solution is your business providing? And does the market need your solution? Number 1. So if you're able to have a business that's providing a solution that is actually needed at a price that people can afford, and it's a big problem that you're solving, then there's a very good chance you're able to get all types of funding. You're able to get grant funding because especially if you're able to create impact. In fact, this is the ideal business, a business that's able to create impact, solve a real African problem. Pick one. I mean, Africa, we are not short of problems in this continent. Pick a problem. If you're able to find a solution to it, and if you're able to create a product around it, and this product is able to create profit around it, my goodness, you have won the jackpot. That's the jackpot. So that's the best value proposition. But you don't have to solve all problems. Just make sure that your product or the service that you're offering is actually solving a real need. And I really want to emphasize that. Just make sure that your product or service is a quality product. We have a lot of poor quality products that we push in the markets, and we wonder why businesses don't survive. Just whatever product or service you're pushing in the market, push it and do it consistently. Don't provide a good service in January, and then March you're not picking up your phone, or you're not picking, or you start being rude to your client. Just provide a good service consistently. Number 2, reach. Understand who you're targeting. Understand who your product or who your service is for, so that you can be able to target them directly and understand what they're willing to pay for it. Number 3, the human element. Understand who you need to have on your team to build your business. You can have a great idea and you can have a great way of, you can understand your market. But if you do not have the right team that is helping push your product, your business can die. And I am an entrepreneur / consultant. So I also know what it's like to not have the right team, and businesses can die if you don't have the right team. The 4th thing, you need to have systems and structures. And I know we had this poll where we said, can your business survive outside of you? And so you need to have systems and structures. So you have a set way of doing things. Like it's, there's, even if you're not there, there's a structured way of doing things, and it is done consistently. I like to use Java as an example. Whether you go to Java Narok or Java Mombasa or Java Nairobi, if you're gonna order, I don't know, what is it? I like that crispy. There's like a crispy peanut salad that they have, crispy chicken. It's going to taste the same. It doesn't matter where you are. If you're going to order a Java coffee, a cafe latte at Java, whether you are in Nairobi or Mombasa or Narok, it's going to taste exactly the same. That's a system that ensures that the product or service that you're delivering is consistent at all times. And finally, if you want to get money from anyone, whether it's a grant funder or a debt funder or an equity funder, you need to be capital ready. Your financials need to be in order. For banks, they won't ask you very many questions. For these other alternative funders that I've been talking about, they'll ask you 20,000 questions. Do you understand your EBITDA margin? Most businesses don't even know what EBITDA is. EBITDA is earnings before interest, tax, depreciation, and amortization. People don't even know why that's important. It's such an important metric in alternative funding, and I don't want to get into the jargon. They'll ask you about your unit economics. Do you understand unit economics? It means if you're going to sell, let's say you sell, you sell a phone. How much are you making? You know, how much are you making for each phone that you sell? You know, questions like that. You need to understand your unit economics, and then you need to understand what drives profitability. And what do you need to do to increase the profitability in your business? Yeah. So in summary, be clear on your value proposition, understand who you're reaching out to, who your target market is, have the right team, have the right systems and structures, and have the right financial structures and financial documentation in your business.
Okay, I think, Doreen, I need to come and see you on the side because this is a lot of information. And I just want to recap just a bit into what we've discussed for the last 3 weeks. So we've talked about why we're getting rejected, and applies both ways to the bank, the direct route of the bank, and alternative financing. We've talked about the foundations of what are needed, and Doreen has mentioned about structures, systems, operational excellence, and it applies across the board. So now I want to bring back Michael, and just for us to walk through now a 90-day readiness credit action plan. Again, after all is said and done, you need an action plan. Like you need to know what to do now for 90. I don't know if this takes 90 days, and 90 days is a stretch, but Michael will tell us if it is actually possible to build this in 90 days for you to actually get a loan. Michael, over to you.
Thank you very much, Wendy. I have survived my man flu and I'm back again. I'm fighting the good fight. So very quickly, the foundation has to be set right. And for any lending decision or any credit decision, you have to have the fundamentals in place. Obviously, I would venture to assume that everyone on the call has an account and the account is running properly. And then, of course, I will not go into registration of the business, but very importantly, check your CRB status, especially if you're running a company and you're more than, of course, these days the law was amended. You can be, you can have only one director. But if you have more than one directors and you tend to borrow, kindly check each and every one of your CRB status, because that becomes an impediment if it's not in place. Also importantly, your tax returns have to be in place. You have to have filed your tax compliance and you are in good standing. Then, of course, but to Wendy had asked this, start simple record keeping. And Thomas, in the previous session, mentioned how that can be put in place. Start keeping records, start being consistent, because that will give the signal, like I keep mentioning, a bank only funds verifiable businesses. So if it can't be verified, it does not exist, the bank cannot take a risk on you. So the other one, and this is very key, now you build your evidence. Deposit all business income through your business account. Very important. If it does not pass through a business account, and more banks are relying on M-Pesa, let it be seen somewhere. So that also speaks to your ability to repay the loan. And Wendy, you like mentioning the thing that there is money coming in the morning and being removed immediately after. Is it justifiable? Because the bank will have the view that if you deposit 50,120 and then you withdraw same day, come the day when the loan is falling due, you will do the exact same thing. I'm not saying don't do it, but there has to be seen that there is money which is coming, because the bank will ask you, or the credit analyst will ask you, was all of it, are you using all of it? Where is the buffer? In case there's an emergency in the office, how do you pay for those? Are your structures in place? And then also prepare books of accounts. And Thomas spoke to this. Now, the one that normally becomes an impediment is your bank statements. Because here we and Wendy, you remember commingling of funds.
Yes.
Separate you and your business. So if you're paying school fees, do not pay through that bank account. Pay yourself a salary as the owner of the business, and then use that amount to pay fees, or take drawings from the business and pay school fees. Because if it is seen going to a particular school, it means that your system structures and governance are not in place. Then, of course, also list all your assets, any vehicles, any equipment. We need to see stock. And because this shows that what is available to the business. And of course, very importantly, get your tax in compliance. And there are a lot of changes which are happening. Be tax compliant. So after that, then you can engage and apply. And very importantly, when the bank asks you to give a profile of the business, they are asking a deeper question than perhaps sometimes is understood. They want to know. It's the same way that when you're asked in an interview, tell us about yourself. You don't tell them where you went to primary school, who was your best friend. And the same thing is said when the bank asks you for a business profile. They want to see who are your creditors. How have you differentiated yourself in that sector? How do you mitigate the risk that are inherent in you being if you're a consultant? Which other people are there in your business that can run the business? How is the concentration of customers? Your aging debtors and creditors? It is a much more elaborate. You need to tell a story that speaks to your credit readiness. So you asked a question, can it take 90 days? It can take considerably less if you have the information, or if you can gather all that information. It depends on you. That's what I'll say, because Thomas had said that between 5 and 7 days, you can have your management account. And Thomas will correct me, and Duncan is also here. How long does an auditor take to give you audited accounts? So it is dependent. I'll say it's dependent on how quickly you can gather that information and how quickly they can be presented. So thank you, Wendy.
I don't know. I think this is when they talk about overconsumption and overload of information, this is an overload of information. Something for me to go back and think about. And I think Paul in the chat mocked me a little bit and said that at this point, it's just a hobby. If it cannot exist outside of me, it is a hobby. Let me just accept, me, I'm in the hobby business. I'm in the hobby life and not the business life. But we are just about 3 minutes into closing the webinar. But before we actually close this webinar, I want to just bring back all our speakers that we've had for the last 2 weeks. That is Thomas and Duncan as well, just for a quick parting shot, because I know we have something for you guys as our attendees who've attended the last 3 sessions. So I'll start with how they appear on my screen with Thomas, and then Duncan, then Doreen, then Michael, and we move to the big announcements.
Thank you, Wendy. Much appreciated. Like you said, this is a lot of information that we've had to synthesize today. So my parting shot is that one of the things that as business owners you should focus on is, one, ensuring that all your business transactions do get captured and recorded. And once those have been recorded and analyzed, then financial statements are prepared out of them. Always take time to analyze your financial statements. Please sit with an accountant, somebody who understands their statements, to help you analyze and be able to come up with, understand certain ratios and metrics and the balances, what is behind the numbers. Now, if you do that, whenever you would need to borrow, then it becomes very easy, because you would be able to explain whatever is required of those statements to potential lenders. So record keeping, accounting, financial statements are very critical for each and every business. Also, please join us. We will actually then be looking forward to hosting you at a discussion where you can come in and we can then on one-on-one just basically be able to talk about this. Wendy will give us further details on when we will follow up with that, but very soon we will actually be inviting you to actually discuss individual issues with us, because we are all situated together in one place. Thank you, Wendy.
Thank you so much, Thomas. Duncan?
Thank you so much, Wendy. Well, my parting shot would be that many businesses
I don't think we can see you, Duncan.
Okay, sorry about that. Can you hear me?
Yes.
Yes. Many businesses would say that they are quite small. They don't need an audit, but there are some benefits which a business can gain from having a voluntary audit. The key being that the key one being that you can be able to identify fraud or errors. That is uncovering internal control weaknesses and risks. Also, an audit helps with ensuring that there is compliance, whereby strict tax and accounting standards will be adhered to, with some of the benefits of having an audit. Then lastly, an audit helps with improving efficiency, whereby you get professional feedback on financial operations. Thank you, Wendy.
Okay, thank you so much, Duncan. So I think again, every single time I hear an auditor speak, I'm just hearing there's something called voluntary auditing. Mambo ni mengi. Doreen, over to you.
Hi, everyone. Apologies. Can you hear me? My network had gone off a bit. Sorry, Wendy. Are we supposed to give a parting shot?
Yeah, just a quick parting shot.
Okay. All right. So what I'd say to businesses is focus more on building a quality entity. Focus on building a quantity entity. Quality entity. When I say by quality, make sure your business strategy is quality, your financials are put properly in order, you're able to track how money is coming in, how money is coming out, and you're able to do it with good governance structures in it. You understand your market, you understand who you're targeting, you understand who your competitors are in the industry. And it's impossible for one person to have that skill set. So surround yourself with the right people. At Sandbox, we have various experts that you can all speak to, with different skill sets that can help you improve the foundation of your business. In terms of money, there are very many businesses that grow without money. In fact, an example that I like to use is a business called Calendly. Calendly is an online app where you can book meetings online. I think I've forgotten the guy's name. I think he's Zimbabwean, and he's based in the States. He was able to run his business and I think the first round that he generated, the first round that he did, and when I say round, the first round of capital that he raised was $300 million. Or he raised a valuation when his business was worth $300 million. Sorry. So he was able to grow his business from worth $0 to $300 million just by bootstrapping. So of course, it's always good to get money, but even if you're not able to get money, just build a quality business.
Quality. 300. I've just had quality and 300 million. I've not had anything else. Quality and 300 million. Oh, and bootstrapping. And lastly, Michael.
Thank you very much, Wendy, and all the speakers for indulging us. And the audience, what I will say is that the money is out there. Banks are constantly looking for people to lend to. The question that all of us as SMEs, because I put myself in the shoe, is, would you take a risk on yourself over a long period of time? I like saying that you getting the money is the wedding day. For the bank, the consideration is the marriage. Do you show the right signals that marriage will last? And with the right expertise and with the right disciplines, that signal can be given out clearly. So the question you should be asking yourself is, if I was looking at my business from the outside, would I bet the house on me? Would you bet your house on that business being sustainable? And with the right expertise, and as Doreen has mentioned, surround yourself with the right people, with the right experts, and that signal becomes more and more clear. So thank you. We hope that we can sit down on a one-on-one, and Wendy will give us the details where we can now get into the nitty-gritty of how this can be done. So thank you very much. And yes, looking forward to having you.
Okay, so now that we have talked about, we've been talking for the last 3 weeks, and we have said there's nothing we have not said. So to that end, on the 4th of June, which is in a couple of weeks, we'll be having a physical session and SME Credit Readiness Clinic. So you see what we've discussed on the internet, on the screens. Now, as Thomas mentioned, we'll do it on a personal, on a one-on-one. So you can come, meet the experts, ask your questions, ask for guidance, retain their services as well. Now that you need to be audited, you can participate in a voluntary audit. So on the 4th of June, we'll be having a physical session where you can just come and meet the experts, ask your questions, get some guidance, and maybe something wasn't answered in this webinar and you'd like more guidance on it. The experts will be there to guide you. We'll send an email with all the details, including the time, the duration, and the location as well. But please be on the lookout for that. If there are any questions, our contact details are on the screen. So you can call us or you can email us, and someone from the team will always respond very quickly to your request. But I want to say thank you so much for taking the time, just spending your time with us the last 1.5 hours. I know we are over time by 6 minutes, but mine is just to say thank you so much. I hope this series has been helpful, has given you some time to think about your business, and if you are ready to take your business to the next step. The presentations and the links to the previous recordings, I know I saw some questions in the chat about the previous sessions, will be shared on email. But thank you so much, and do have yourselves a lovely, lovely Thursday. Asanteni sana, and see you at the clinic in 2 weeks' time.